Good morning, everyone. So my name is Ralf. I'm responsible for real estate debt at Edmond de Rothschild in Europe. And I'm also the fund manager of our pan-European high-yield real estate debt fund, for which we're currently fundraising. Thank you very much for the order. Very honored to be here this morning, and thank you very much for showing up. I think the participation rate has dropped a little bit compared to yesterday. So I really appreciate you being in the room and giving me the opportunity to share my thoughts around how to create outperformance in an inflationary environment by focusing lending on operational assets. And I brought you a case study of a hotel transaction that we financed earlier this year, as well as with regards to traditional real estate achieving outperformance by structuring mezzanine investments. And again, I brought you a case study of a hotel transaction in Hamburg in a very core market. But before I get started on the case studies, I'd like to spend 1 or 2 minutes, if I may, on Edmond de Rothschild, because yesterday over the dinner, some people asked me, hey, there's another Rothschild in the market. What are you guys actually doing? So Edmond de Rothschild is the French side of the Rothschild family, and basically we're an investment company. We also own a private bank. Total AUM is about 160 billion. There's another Rothschild in the market called Rothschild & Co. So that's our British cousins. They focus more on the corporate finance side, amongst other things. Within the 160 billion AUM that we have about 12 billion assets under management on the real estate side, on the equity side. In total, you see that on this chart in the middle, we have 120 people on the operational real estate side. So from guys buying real estate, selling real estate, down to asset and property manager, vertically integrated. With people across Europe, you see it on the left-hand side on the map. So we have boots on the ground in basically all major Western financing markets. And that's important because it gives me 2 advantages on the debt side. Number one, when I underwrite a new loan, I can use my in-house colleagues in London, in Paris, or in the other jurisdictions to help me assess the risk. So I'm not just relying on external CBRE or Savills studies, etc. And the second point is also very crucial, and I heard it sometimes yesterday. In case there should ever be anything going wrong with my loans, I have the ability to take the keys and take the assets over and manage it in-house on our own platform. So we're not forced to actually dump it into the market.